Let's talk about the 3 ways you can access cash. You have bad, better, and best. Let's also talk about how you can withdraw or borrow cash from your life insurance policy. We're gonna go over things that you probably never even thought existed, like how to accumulate, access, and transfer your money completely tax-free. My name is Justin Smith, and I'm here to tell you that your 401k is not enough. I've helped educate thousands of people about the risk in the tax mitigation, and I'm here to empower you about how we can close the wealth gap here in America today. So when people ask, how do I take money out of my life insurance policy? I'm here to tell you that there's a bad way, a better way, and the best way. In a nutshell, the bad way or the sad way is from dying. Between me and you, it's probably the best return on investments, but I do not recommend it. If I were to put $5,000 to $10,000 into a life insurance policy and actually die the next day, all I want is that my beneficiary to act real sad, because when I die, they're gonna be rich. This is because they're gonna be stacked with tax-free cash. Yes, it is a sad way to die, but if I were to put 5 to 10 grand into a policy and when I die, my family gets millions of dollars, that's not bad for my family, at least, and not to mention it's completely tax-free. Once again, it is an amazing return, but I do not recommend it, okay? But when it comes to life insurance these days, people really don't even stress off the death benefit no more. Usually the stress comes from paying for it. This is why I recommend the Index Universal Life Insurance policy or the Smith Fund, because it looks, feels, and sounds better than ever, because it is tax-free. You'll be able to access that money completely tax-free. So if there was $1 million in the account, you can generate anywhere from $80,000, $90,000, $100,000 a year before even touching your principal. This is something IRAs and 401ks can't do. You will never be able to predict that type of income with your money tied up in the market. Not to mention all the taxes and fees that come with it as well. So in most, if not all cases, this has become a dream resolution for many people getting into retirement. You max fund the life insurance policy, you take the least amount of death benefit that the IRS gets you, and you turn that thing into a cash cow. So when it comes to withdrawing your money and you want to do it for the living benefits, I recommend the best way. But when it comes to being the better way, it's just withdrawing your money. When you have money in a cash value of a life insurance policy and you need quick access to that cash, you can access that money and withdraw it, meaning that is what's called a surrender or a partial surrender. But there's one problem with the word withdraw. When you withdraw your money, it puts a limit, or it actually stops you from being able to reinvest or put money back, loan yourself back money into that policy. So withdrawing for me is not always the best way, because you can potentially lose all the growth that you've been working towards, and there's some tax benefits that you could be missing out on as well. So when it comes to life insurance cash values, they're taxed FIFO, and most other investments are taxed LIFO. FIFO is first in, first out. LIFO is last in, first out. So if you were to put $500,000 into an annuity, annuity is a savings component in the life insurance policy, or it's a life insurance product that we'll talk about in later videos. But for example, let's just say you were earning 10%, which in annuities, most of us are not, but just for this example, $500,000 at 10% means you can pull out $50,000 a year, right? So in that case, the IRS says that's the last money you're earning as interest. Only if you pull out from the original money that you had in there do you actually get the tax breaks. So the last money that you are putting in there is the first money you're taking out, which is used for investments. Insurance is one of the few that are in the Internal Revenue Code that are taxed FIFO, first in, first out. So if I put in $500,000 and 10 years later, I want to start taking out 10%, meaning I want to take out 50 racks a year, that means they will tax me on those gains. That's dumb. But the IRS says we don't even need to do that. Basically, the IRS is saying, just change what you call it and we won't tax you. Don't call it a surrender, or don't even call it a withdrawal. Call it a loan. Now you may be thinking, what? Borrow my own money? Why would I borrow my own money, Justin? What's going on? Because this is what the smart and the best people do. So when my clients come to me and they're like, Justin, I need money for my kids' education, or I need money for my retirement or investment or any type of venture, they know the procedure. We got a one-page form that we need to get from the insurance company. So of course, they put their name at the top with their policy number at the top, which is like an account number. And then it says, would you like to withdraw $1 million? Now, it all depends on how much money is actually in your policy. But for this example, let's just say there's $1 million available for you. So let's say I have a business owner client who needs money for real estate. They'll call me up. They say, hey, Justin, I need one of those forms. Can you give me one of those forms? Email me one of those forms. And of course, I email them the form. And on the form, it says, would you like to withdraw this $1 million or would you like to borrow this $1 million? I think you and I both know what he should say at this time. Hopefully you said borrow. See, because if he withdraws it, he can't put that $1 million back within those same guidelines that he had before. So he's permanently taking that money out that he cannot put back into his policy. Mind you, this is slowing down, if not stopping, the tax-free growth. Also, if he takes out more than his basis, he would have to pay unnecessary taxes and fees. So then he decides to borrow, and at this point, he has two choices. Choice one is, do I check this box as a zero-wash loan? You know, right now with the economy struggling and things aren't looking promising right now, he might just take the zero-wash loan and tell the company, hey, I want my $1 million. I just want to borrow my $1 million. Now, in order to be considered a loan, the insurance company will have to charge you a nominal rate, which is anywhere between 2 and 5%. So they charge him 2%, or they would charge him 2% on his $1 million, meaning he would have to pay $20,000. This $20,000 doesn't have to come out of the pocket, nor does he really have to even pay for it. But if that's the case, Justin, how is this even covered? In that case, the insurance company will then collateralize his 2% and then also credit him 2% on the back end, meaning 2 and 2 take each other out, zero wash loan. So that means he's earning 2% on the money he did not withdraw. It's still sitting in there. The insurance company will then use his money as collateral. In other words, the money was not touched, so it's still growing. The insurance company then loaned him the equivalent of the cash value. So at this point, he's only paying 2% because it's already credited. So he earned 20 racks, and he also was charged 20 racks on the loan, so it cancels each other's out. And now it's a zero washed loan. But why would we even do that? Because loan proceeds are not deemed passive, earned, or portfolio income. They are deemed tax-free. This has been in the Internal Revenue Code forever. We just did not even know about it. So this is what makes the $1 million completely tax-free. But there's always another option. You can also choose to pay a little bit higher interest rate, around 4 to 5%, which is what we call an index loan or a participating loan. Now on $1 million, let's say you're charged 5% on the index loan, they're charging you $50,000. Now, why would I give them $50,000 when I can just give them 20 racks? That's because the insurance company will actually credit you on the full $1 million because you're taking the index loan. You're playing in the index at that point. So that's what you're participating in, and that's what you're also credited. Think about the years that people were borrowing at 5%, but they were earning 16%. Like, could you imagine using the same ledger that charged you 5, but you're gaining like 25%, while that money is in the index gaining you 16%? So let's say out of $1 million cash value, they're taking out 10%, meaning they're taking out $100,000 a year. They're charged 5% on an index loan, but they're also gaining 7% for participating in the index or on the index. That's a 2% spread right there. So if that's the case, instead of taking out $100,000 each year, he's able to take out 120 racks each year. The best way to take your money out or to cash out. Also, not to mention, they're earning that higher interest rate than the insurance company is actually charging. Also, the loan is never payable during your lifetime. When you die, it washes away. But you can pay it off if you got new money coming in. If that's the case, you can reinvest it back into the policy and do it all over again. The insurance company would then look at it like, oh, he's just reinvesting into his policy. And the IRS will say, oh, he's just paying back his loan. So you really don't have to pay anything. And if that's the case, you've already complied with the IRS guidelines. And like I said before, you can do it over and over and over again. But hey, listen, if this is something that you think, Justin, I got to get my hands on, I got to know more about this, click the link in the description right now. It's called the Smith Fund eBook. It gives you start to finish of how to set up these policies and get yourself started for your family, your future, and your goals. My name is Justin Smith. This is the Investments YouTube channel, and we'll see you next video. Peace.
you.